All right, ladies and gentlemen, I hope you had a wonderful day. We had Jerome Powell in the Fed, and my, oh my, was it a confusing one. I'm not the only one saying that. If you look around Wall Street, analysts, well-respected bond people, almost everybody, they said there was a lot of confusing signals. Here is just the SEP. We will go into the dot plot. I have a really good video for you today. You're going to love it, but at the end of the day, the moral of the story was we are expecting higher rates coming into 2024, and there's a weird optionality for this year that makes it crazier. You look at the GDP, the unemployment, there is a lot of confusing, contradicting things, but it kept up this strategic ambiguity, and now coming into the end of the year, we're not going to get an update on this for a minute. So I got a couple things I want to show you before we start this video, but let me tell you what we are going to do in this video, because it's weird how it all played out, man. I was getting ready to film the video, then my father, he somehow arrives at my house, man, and my whole life, I've known him for a long time. It's like my dad, you know what I'm saying? Like, dude, he asks me about the Fed. And I'm like, okay, this is great. And I'm like about to explain to him what I'm about to put on the watch list, right? So I just record it. So you don't get the excitement. You get me talking to my foreign dad, and I get to explain to him some of the confusing nature of today. And if you don't know about my parents, man, you don't know about me. You may have not seen my face ever, but you have been here for years. Some of you, if you're new, welcome, and we love you. Hopefully you check out the stream. But, you know, my parents are immigrants. They came from another country, I think in like the 80s or something like that. But it's interesting because his economic background is much different, and it's part of why we do what we do, man. Like, for real, if you ever talk to my dad, you talk to me and see, it's like, you know, I have gained this knowledge that I have had from sources all around, from school, trading economics, and no, I'm not paid to say that, you know, and that's why to share it, I really hope you get the same passion for economics and the market and everything, regardless of your background or whatever, and that's what we want to share with people. So I like this video because it's kind of dumbed down a little bit. It's like, again, he has no knowledge of a lot of this stuff. I'm sure I said words and he's like, yes, yeah, okay. You know what I'm saying? But it's really, really good. But before I show you that, what I really want you to understand is two things. One, coming into tomorrow, even though today was a big day, there was a lot of weird reactions that I'm going to show you after this, but it's very simple. Tomorrow, there is a ton of data by the time we wake up in the morning. You're going to have the Bank of England interest rate decision by 7 Eastern. Then you're going to have another vote there. They're going to do their little meeting minutes and all of that. You get the U.S. current account. Then you get initial jobless claims. Then the Philly Fed, new order, prices paid, CapEx. Then the jobless claims, continuing claims. Then the ECB President Lagarde. Then an ECB consumer confidence flash. Then another ECB speech. Then an 8-week. Then a 4-week bond sale. Then existing home sales. 30-year mortgage rates, 15-year, and then a 10-year tips auction with GFK Consumer Confidence. That's Great Britain. That's after the bell. And then that night, you have the Japan inflation in the Bank of Japan. That's all tomorrow. But what I'm telling you is by the morning, you know, whatever reaction you saw today, you are going to have a lot to react to. And that's what made today kind of weird, because the bonds, the market, the dollar dropped, market went up, bonds caught a bid there all this morning because there was positive UK inflation data, and it changed the odds of a hike the day before their meeting. That's how volatile it was, but it was good for bonds. It had a nice effect by bringing the dollar down, but then by the time Powell spoke, the dollar rocketed, equity started to fall, and then this was something that we kept bringing up throughout the day. I really want you to notice this. It's like the market went with equities here, but then throughout the day, like this little drop right here, I want you to notice bonds barely dropped and broke below Powell's first, the statement move. It happened like right at the bell, but look at this. All of this from like here on out, that is all after hours. So it keeps dropping now. It's a very interesting, very, very interesting reaction, because again, with how hawkish it was, the implications, which I explained in the video with my dad, it's mind-blowing to think that the bonds didn't move, but now if it was true and people do believe Powell, the bond yield should start breaking out and start going past 2007 highs, and who knows where it takes us next. So that was a crazy dynamic, and what I'm telling you is I think this is going to play out tomorrow with all the data. Don't forget last week we had, CPI or non-farms. We were so excited, but then Europe got in our way. It can affect the dollar. Bonds are also reacting to our own policy, so it's going to be an interesting follow-through over the next couple of days. So that's all I wanted to share with you, and now let's get into the video. I hope you enjoy it, and I hope I see you on stream, but run it.
Walking to the couch, it's the joints on the legs. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel like it's a blessing. I just want the leg. protection. I'm up and I'm down, but the sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it down.
This is what came out 3 months ago.
3 months ago? Okay.
This was their summary of economic projections.
Okay.
So what they do is every 3 months, they tell you where they think the economy will go, the unemployment, inflation, and then where they think interest rates will be, right?
Okay.
So they put this out 3 months ago, and it said next year, they think interest rates at the end of next year will end at 4.6.
Which is good news.
Is good, exactly. It'd be lower than where it's at now. But then today, this is the new one today on this screen, they came out and they said it's going to be 5.1. So some people thought it would have been higher, maybe like 4.9, but now 5.1, that's 2 more rate hikes.
It's not that much.
It may not be, but this is the part where they confused anybody. There's a lot of other stuff, but right here, it shows the dot plot where what every single person agrees on the Fed and shows it. But compare it to last time now, like you could see you had more dots at like 4.2, right? Which would be like right here. Now you only have 2 people.
Where?
So here, on the last meeting, you see 1, 2, 3, 4, 5, 6. They're at like 4.25 to 4.5. Right there. You see that? That was 3 months ago. But then today, those 6 people they've now spread out to higher rates. So even though this number, you just said it. You said 0.5 in a year, not that much. It's still, but then when you go here and if you do the math and try to find the median now, as compared to the earlier one, this is 100 basis points. So now it's 1 full percent. Because this one is just a median. So that's why, same as this one, but then when you compare it to the prior median last time, the gap now is too big. And
Who is those dots represent?
The 19 members of the Federal Reserve.
Oh, okay.
So that's where...
They voting on stuff? Or
they just put where they think it's going to be. So they're the ones saying, we think it'll be there. It doesn't mean anything, but the market looks at it, and so do other people. But that's the first part where this right here now, and then it leaves them in a position where it's confusing enough. They have optionality where if like they could pretty much raise or lower rates however they want. But now this signals to the market that, and market already thought we were done raising rates for the most part, it's signaling it could be 100 basis points more. But now where it gets even more confusing, and this is what people are saying today. People are saying that it's confusing. There's a lot of economists today that came out. There's a lot of headlines that said that. But it's because when you look at these numbers, the Fed is also saying that GDP is going to go up this year, drop next year, come back up in 2025, and then go and stay the same in 2026, right? But then they're also saying that in those next 3 years here, in the next coming years, they also say unemployment's not going to go up.
Oh, really?
So it doesn't make sense.
Yeah.
GDP goes up, the economy's going to do better, but unemployment's not going to change.
GP, which means...
GDP, gross domestic product. So that's all of what we produce in the United States.
Well, it will go up.
They're saying it's going to go up, but they don't think that in the next 3 years, if it went up, they're also saying we don't think it's going to affect unemployment. That doesn't make sense.
Yeah.
Even you made the face.
It should lower it.
Exactly. There you go. But then also at the same time now, they're also saying inflation is going to stay high, slow down a little bit, and then get back to that 2%. But again, if the economy is going up, unemployment's going low, why would inflation stay the same? Especially after what we've seen.
Then what do you think from all of this?
It's what I was saying all day today. I think they wanted to kind of scare people into not gambling on the interest rates, because by this message clearly shows they could go 50, they could go 100, either really small like you said, or it could be a lot bigger. But then at the same time, you go down through here, it's also telling them that they might be able to shift. If the economy runs into a problem tomorrow, these dot plots can all move. But now pretty much the main thing coming into the end of the year is that there's...
End of next year.
End of this year, people are kind of done with it.
Oh, yeah.
So but now if you thought anything about next year, This is setting the frame for next year that it's
But-
still going to be higher interest
But
rates.
when is the interest rate?
So every couple months they have the meeting every month, and then like it's like every other month. But the problem is they don't change this. So what I'm showing you now, they only do this every 3 months. So we're not at there. So they just sent this message. A lot of people took it as confusing today, but then 3 months from now it could change. So
Yeah.
it doesn't tell us much today. It's kind of confusing, but I think that's the point.
I think is they try to hold the stick from the middle, in case if things went wrong, they will say, "Did you guys read
Yeah.
our report?" If something went good, they say, "Hey, we have good news for you."
Yeah, exactly. You get it. That's it. That's it. That's 100% it. But
Yeah.
now, if you want to invest, right?
But
You want to do
from what's going on today, I don't see any good news coming.
There could be though. That's the thing. They're trying to go slow, but it's
How?
by doing this, by waiting, little, confusing you, not saying we could do it, we can't, and playing that game where if anything goes good or bad.
Yeah, people will hold
But that's
until next year.
they will, but then also people doubt it because it's hard in the investment world to wait. Because if you want to buy a house, you want to buy stocks, you want to loan for a factory, right? If you're looking at the interest rate and you're getting this message, you don't know what to do. So they don't want to wait.
I don't care about the rate,
Most people, it will come down eventually. But if you are,
but not this year.
yeah, well, it might though. That's the paradox. So they're saying no, 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 no. But like you're saying, things don't look good. That's the other side of the coin. Because
Now, if they didn't lower, is lowering the interest rate will make the economy higher?
it will, but that's what happened during COVID. Remember, they cut the rates. Houses went up, everything went up. Even after '08, they cut the
Yeah.
rates, it spurs demand. But at this point, they're raising it because they want to slow down demand. But if they cut again, that's what I've been saying.
Why do you want it to cause the demand?
Because it causes inflation.
Ah,
Because now there's not enough items, but there's all these people who got a bunch of free money and everything else, and then the stock market, there's all this money in the world now, way more than even 10 years ago. So now they got all this money, they want to buy, but then it leads gas prices, houses, cars. That's why everything's so expensive now.
yeah.
So they want to make interest rates higher because if you slow people down from buying and make it more
What
expensive,
does inflation mean? It's the power of the dollar.
very simple. The same item
Uh-huh.
cost you more money. The exact same thing. So if you bought this mouse last year for $10 and then this year the same exact thing is $12, you're paying more money for the same item. So your dollar has less value. So what they want to do is slow down demand, raise the interest rates so that the dollar could be stable. They don't really care about too weak, too strong. They just want it to be stable. Because the last 3 years, look at how fast house prices went up. Cars and everything. They don't want it to go up and down. They don't want, when the stock market, you could handle it, but it's like when it goes up and down like this, that's not, you don't want up and down. You would rather have slow and steady, or you'd rather have same price for a year. But for everything in the world now,
This is like the
this is the S&P.
and like when they do your heart EKG.
Kind of, yeah. Kind of like an EKG. That's what it does.
EKG is terrible here.
Yeah, exactly. If it's smooth pattern, same,
Yeah.
the world can handle that, the government, the Fed.
Wow, it's going down and up.
But like, here's the thing. You see how it goes down and up? That looks weird to you, right? It looks crazy, but it's not. Why? Because look at the price it's at today. Go back 1 year ago. Right? 1 year, September, where would it be? September 2022. We're higher than last year, but then go back now 2 years ago. You're the same price as 2 years ago on the stock market. It didn't move.
What does it mean then?
So in the short term, it's unstable, right? You're looking at that chart, you're like, that's crazy. But 2 years ago, if you just bought the stock market and didn't look at it, it would be at the same price it is today from 2 years ago, even after all of that movement.
Oh,
So that's stability in the long run.
Okay.
Because then now you look back at it, it's the same thing with oil. So like, this is the chart for oil. It's the same exact thing. This is a 2-year chart. Go back 1 year ago, you know how oil went crazy? It's the same price as a year ago. Most people don't believe that if you don't look.
Yeah.
It's the same exact price. Go back 2 years ago now, and go back to September, you're like $20 higher. By October, it was borderline the same price it is today. So the idea here is that you want, that's good though, you want stability. Because if it doesn't, if inflation goes too much, all of that, all these things, they lose stability. So that's what happened today.
Okay.
There you go. That's all I'm going to make my video on, man. Let's go. You ready?
Yeah.
All right.